This is a medical marijuana company that is just listed on the New York Stock Exchange.
So they're mostly in Florida. They control the entire, more or less, the chain of how the operation goes from like when the seed's made, cultivation, growing, and then eventually selling. So that way they can save on costs and things like that because you don't have any or as much third-party stuff for them to deal with, which is good. Saves them money and makes the process easier for them. Let's jump kind of into the money aspect. So like I mentioned before, they're originally in Florida, but they did have an acquisition. And this acquisition was for a company called, it was for $2.1 billion, and it was called Harvest Health and Recreation, which provided instant scale, adding presence to Arizona and Pennsylvania, vaulting revenue run rate toward an estimated $1.6 to $1.8 billion in 2025. And it says, despite 2080E tax headwinds and fragmented state rules, Trulieve leveraged strong Florida cash flow to fund expansion with limited leverage. And so the nice thing about that is that, at least for them in Florida, it mentions that they are one of the bigger players. So it says right here, strategically, Trulieve doubled down on operational efficiency, closing underperforming assets and concentrating on high margin indoor cultivation in 2025, which expands gross margins by around 300 basis points. Its first Florida first moat, near monopoly convenience, high brand recognition, and robust retail density, plus supply chain optimization and rapid legislative adaptability. And then it says, quote, or not quote, parenthesis, potential Schedule 3 rescheduling upside, sustain a durable competitive edge versus smaller rivals. And then we're going to be talking about the Schedule 3 reschedule, or the Schedule 3 rescheduling very soon, just because that's important for the fact they're going to try to be listed in the New York Stock Exchange. And without that, we probably wouldn't be able to see that happening itself. Through 94% of total revenue in most recent fiscal year came to direct-to-consumer product sales, 2025 annual revenues topping $1.2 billion. High-volume dispensaries in Florida, Pennsylvania, and Arizona anchor sales, while product mix of smokable flower, which is about 45%, concentrates and vape cartridges about 30%, and edibles and accessories about 25%, lets them capture consumer price points and occasions. So they have a lot of different good things going for them. Different price points, different locations, different product types, and they also are going to be they also have revenue from like subscription services and things like that, so they can keep getting more and more money even if you don't come in. It mentions down here the company deploys a good, better, best pricing ladder. And it says, e.g. value roll 1 to premium cultivator collection, leverages excess production for selective wholesale contracts, and uses loyalty/subscription replenishment models that support a 70% plus recurring customer rate, driving higher lifetime value and stable same store sales growth. So doing pretty good, have some good practices in place to keep the revenue flowing. So yeah, that's kind of it about them, how they make money, that kind of thing. So we kind of want to shift our focus a little bit to now why they can be essentially listed on like the New York Stock Exchange and things like that is because of the rescheduling of marijuana from a Schedule 1 to Schedule 3. Basically, it adds a lot less restrictions and basically says it's a lot less dangerous of a drug compared to something else like heroin or something. Trump, he rescheduled the cannabis from Schedule 1, which is the most restrictive, to Schedule 3, which is the least restrictive. And basically, this has kind of opened the door for Trulieve to try to make this push to be listed on the New York Stock Exchange. And so, because of that, obviously, other companies who are in the cannabis space are going to be looking at that. Mentions like a lot of the competitors are going to be seeing like how the company does. It was just listed in June, so there's not too much time with it yet, but it's one of those things where like, well, if this company starts to do pretty well on it, because that's a Schedule 3, all the other cannabis companies are like, well, we want to get investors too on that front and the stock grow. So it's definitely one of those litmus tests of kind of seeing how it plays out, especially from the legal standpoint, just because this is the first one to do it. Competitors are going to be interested in that. They want to see if they can get on that same thing, if this ends up going well, because everybody wants to make money. That's why they're listing on the New York Stock Exchange and other stuff like that. But one of the key things about why they're able to do this is because they separated assets. So it says here, Rivers separated the company's, Rivers is the CEO Kim Rivers. Rivers separated the company's medical assets from its recreational assets, which seems to have satisfied the exchange regulators, but the company's unique footprint in Florida makes its medical-only business an investable asset by itself. The company controls about 30 to 40% of Florida's medical cannabis revenue, depending on how you back in calculation. And while Rivers has control over the company's recreational business, those profits will not flow into TRLV's balance sheet. This is the ticker, by the way. I don't think I covered that in the very beginning. The big caveat is that they're not only able to, because they're Schedule 3 now, but they're also separating how the money's earned and then how that's split to be able to list on there, because the regulators want to make sure there's a difference in it, which is also something important because not all the other competitors will do that. They have just revenue as all those numbers combined. So that'd be something they'll have to consider if they end up doing that as well. you can't just list itself just because it's Schedule 3. It seems like there's other hoops they have to jump through to make that happen.
Mhm.
So now we're going to switch over to earnings. There's not too much we can find like from a specific article like we normally like at CSNBC or something. Couldn't really find it, so we had to a Gemini search. So it kind of just did the work for us. But like I said, we normally do check to see like sources, things like that, just to make sure numbers are accurate. Essentially, this is more or less what we can find. And so earnings per share, Trulieve reported a Q1 2026 diluted earnings per share from continuing operations of 2 cents and an adjusted diluted earnings per share of 10 cents, driven by 286.8 million in revenue and 56 million in cash flow from operations. Results indicate a return to profitability. They got the 2 cents. Adjusted diluted earnings per share is 10 cents. Ironically, they were estimated at -5, so they actually did better than it was expected. So good for them. And then revenue, actually, when we looked up revenue, like I said before, 286.8 million, but it's a decrease from a year ago, but it beat the estimates that they were originally having for it. So good for them. It also had profitability. It's a shifted from a net loss of 32.9 million in Q1 of 2025 to net income of 2.4 million. So again, good for them. Most of these marijuana companies, like they can be decent sized, but not like crazy huge, like some of the stuff we've covered in the past. But it's good to see that they're turning into profitable. It's also good to see that even though the numbers aren't the best, they're still beating consensuses. So good to see that. But yeah, so that's a little bit about them, how they work, how they operate, why they're now being able to kind of be listed.
This is simply Wall Street, and you could see here for the free cash flow, we have that it's currently 176 million. Next 3 years, going to be 166 million. So it went down a little bit, 10 million. I think this is actually wrong. I think they'll be a little bit more profitable than, or in free cash flow wise, what they're projecting currently, because they just had their first profitable quarter, like Dom said. Truly amazing, especially for pretty much you could say a newly listed company. I mean, I know it was IPO'd a while ago, but really it's on the New York Stock Exchange, so they're audited more by official resources. So that being said, the financial health of the company we're looking at is incredible too. You have equity, which is great. Cash is higher than the debt level. So current cash is 352 million, debt is 290 million. So really good on that front. Nothing to complain about. We have that currently trading at $8, or we could just say $9. And what's interesting is the 52-week low is $7.92. The 52-week high is $12.30. So that's pretty good, I would say, in general. Keep in mind, though, and this is going to shock a lot of people, it's up 136% from the past year. Market cap's about 1.7 billion. So this is certain, not micro cap, but it's small cap company. So you have to be a little bit more cautious with these types of companies because they're generally not that profitable. They sometimes have a quarter here or there, but not a full year. So keep in mind of that. Now, that's going to actually be reflected right here, which is their net income. Their net income in 2022 was negative 246 million. Now it is about 81.1 million. So they're certainly trending in the right direction that they're going to have finally a full year of GAAP profitability or net income positive. But you still just need to be very careful with these companies again because they are like this, that they trade extremely high one year and then the next year they crash like 80, 70%, for example. So you do have to be careful. And if you look at the 5-year chart for Trulieve, it's down 73% still. So just still be careful. Now, when we check my DCF on it, my DCF is going to say it's overvalued by 7%. Historical growth, Wall Street doesn't have a forecast on it yet, probably because they just were profitable for the first quarter. But yeah, more or less so, you just have to be a little bit cautious of that. This is Canadian dollars. You're wondering why it looks higher. It does translate, but yeah, just be a little bit cautious. It's slightly more expensive. And lastly, Tipranks. Tipranks is going to say it's a strong buy. We have that it's 107% upside. We have a low of $16, an average of $18, and a high of $19. So you do need to be a little bit careful. And keep in mind, the only real two notable analysts here that are covering it are, I mean, even so, the records aren't that great. You really want to look at 5-star analysts with the batting rate, you could say. There's this guy's success rate. He has almost 5 stars. It's not that successful. So he has 44% success, and this guy's 41%. So you just need to be cautious with these types of companies. I do like the stock. I'm glad that it's, you could say, officially listed on the New York Stock Exchange. And it looks like a lot more of these companies will be listed. It's certainly interesting, but just be careful, I would say, in general. Just be extremely cautious with these types of companies.